Hey everybody, this is Richard. So today I'm going to be doing the end of month April 2021 review of the performance of the algorithms. Before I do that, I'm going to give a disclaimer, then I'm going to look at the momentum 10-year, the momentum S&P, and the momentum day trade. Kind of individually, we're going to look at them pretty closely actually, and then I'll give the algorithms a final grade, and then we'll look at the legacy performance of the swing, the wave, the crusher, and the pro trader. All right, so let's go ahead and get started. Now, before I go over any of the results, I do like to show the risk disclosure, and feel free to pause this video at this point and you can read through it. But basically, this is just a reminder that trading futures involves substantial risk of loss. It's not appropriate for all investors. Keep that in mind, as well as the fact that we are a third-party developer. I'm not a commodity trading advisor. And so with that, why don't I just jump in and we'll start looking at how each algorithm did. Okay, so what this is showing is the performance of the 10-year. So as you know, the Phoenix algorithm trades three algorithms. It trades a momentum 10-year, the momentum S&P, and then the momentum, the day trade S&P as well. Now what this is showing though, and you'll want to pause this and try to look closely at it to kind of understand what I'm showing, but basically all this is showing is the momentum 10-year. So let's look at the chart on the left first. This just shows the momentum 10-year along with the S&P. Now the teal color is the S&P 500, and all I've done is I've just assumed that someone was trading something like the SPY ETF, and so if the S&P was up 1%, then this would show on a 20K account being up about $200. So that's just to give you your bearings. That's kind of what this shows here. But you'll see that really all it's doing is it's showing every day of the month, including the weekends, which is why it looks you have the gaps. But you'll just see that the teal or the kind of light green or the greenish color shows how much the S&P was up on each day. The orange color just shows the momentum 10-year. And so like what you might first notice is that the first few weeks of April, there's no 10-year here. Well, that's because we were not in the 10-year. If you remember, and I'll pull up a chart and kind of show you again. Yeah, so this is just a chart of the 10-year. And so as a reminder, the beginning of April, so April was back here. This is where April started. Notice we were not in any trades, and then we bought into it on the 14th. And so that's why what this PowerPoint shows is kind of no orange until kind of mid-month, and that's when we got into the 10-year. And this is just the day-to-day change, kind of as a mark-to-market of that 10-year trade. So notice the first couple days we were up. The second day in particular, we were up a large amount. That was on that big spike. And again, that corresponds to this day right here, where the 10-year spiked quite a bit. But then after that, you'll see the 10-year did sell off a bit, and so we had kind of a losing day, another losing day, and then another up pretty good day, and then another few losers. But this just shows the day-to-day though. The reason why I'm showing it like this is so that you can compare how the 10-year did compared to the S&P. So again, remember, this is our hedge algo. So this is designed to do well when the S&P is going lower. So what that means is on these days where the S&P is down and you see the teal kind of going below into the negative territory, what we want to see is that the 10-year was up on those days. Kind of like you see on this last day where the S&P was down and the 10-year was up. Now it's totally normal to see the flip side of that too, where the S&P's up and this 10-year trade is down. But here's another one where the S&P was, and I know you can barely see it probably, but where the S&P was down and the 10-year up. So it's not 100% negatively correlated. In fact, the last time I did the correlation, it was about negative 30%. But what I'm showing on this second chart next to it, the point of this is to show the cumulative. So this just shows over time, you see the S&P growing in value, as if somebody were to have bought at the beginning of April and just hold, they would have seen their net liquidating value just kind of slowly climb and then flatline a bit kind of over here. But what this shows is how the value of the 10-year kind of fluctuated, but overall was up. And so that's really good, actually. The fact that we were up, even though the S&P was up, is a really good sign. And that's why I gave it an A+. So the S&P closed up about 5%, and the 10-year trades were positive. This is a very strong outperformance, considering usually what we expect is that if the S&P is up, that the 10-year would be down. But in this case, the 10-year was actually up, and it was actually up by about $200. So on the Phoenix, that's up about 1%. Again, Phoenix trades in $20,000 unit sizes. So that's mainly what I wanted to share on the 10-year, is that it actually did really good, even though, again, it doesn't always feel that way, because we did have a spike in the performance, and then you see it kind of trickle off, and we give back a lot of the gains that we had. But that's why I do like to look at the final kind of closing numbers for the month, because it does help give perspective again. And in this case, the fact that we were up on the 10-year, really since we got into the trade, we'd been up on it, is really good. It just means that our hedge did better than what we would have expected it to do. And as you know, if you follow me and the algorithms, I talk a lot about not just the raw numbers of how the algo does, but how it did compared to how I would have expected it to do. So in this case, it's a very clear outperformance. Now, I think that's probably all I really wanted to talk about on the momentum 10-year. So let's look at the S&P algorithm now. Okay, so what I'm doing here is I'm just showing a similar chart, only for the momentum S&P. Now, as a reminder, and I guess I should have mentioned this, but the momentum 10-year is traded on all algorithms that we offer, including the legacy ones. The momentum S&P, this momentum ES algo, it's actually traded on all of our algorithms except for the wave trader, which is one of the legacy ones. So if you're watching this and you trade the swing trader or the pro or the crusher, this actually applies to you as well. This is the main momentum S&P algorithm, and the momentum 10-year applied as well. But yeah, but I think enough on that. Let me just kind of jump into how it actually did, though. So the first thing I want to say is I did give it a grade of an A, and the reason why is because the momentum S&P closed higher, but and so we would have expected the momentum, the S&P closed higher, so we would have expected the momentum S&P to also close higher. But the fact that we closed higher by such a large amount, and if you watch the weekly videos I've been doing, you've seen that we had, I believe it was 15 winning trades in a row, and I believe only one loser. And so this algorithm actually did really amazing. And what you'll see is that, as we would expect, it tracks or it correlates fairly closely with the S&P. But again, if you're watching this and you don't really understand what we do, this is just one of the 3 algorithms that are in the Phoenix. So this is the one that does happen to track closer to the actual S&P performance. The 10-year, that's the one I just did. That's the one that is designed to do well when the S&P is going lower. And so, but again, this one here, it's definitely fairly normal to see a correlation between the S&P and the Phoenix ES or the momentum ES. A couple things do jump out, though. Notice how there are a few days where the S&P closed lower. I'm looking at this day right here, this day right here. I thought there was another one, but those were the 2 main ones. I think this one right here as well, where the S&P was lower for the day, but the Phoenix ES or momentum ES actually was higher by by a large amount, as was the case here, and also this one right in here, and then and then this one here, it was up a decent amount. But I want to go to this chart and kind of show you what that is, or why, or how that even happens. So let's go ahead and look at the chart. Okay, so here's a chart of the momentum S&P, and what what you'll notice is, again, remember I mentioned that it had about a 15 winning win streak, positive trades, that is. So on the 30th of March, we did get stopped out of a trade. That was the last loser we had. Then we had 15 consecutive winners. And it wasn't until the 30th of April, the last trading day of April, that we actually had our first loser. But remember, I showed you how there are times where this algorithm actually is positive even though the S&P is down. Well, this is an example of how that happens. So we might get into the trade and the market might open just kind of flat. It trades up and we got out with a gain. That's what that kind of teal dotted line shows. And then the market sold off. And so this is a great example. In fact, this is the 14th of where the S&P is actually down, but we actually are up. And so that corresponds to, let me make sure I can find it here, but the 14th, so it would have been this little kind of blip here, I believe, where, again, the teal was down, but the orange was up, showing that winning trade. So so it does happen, and when it does, it's obviously really good. I mean, that's how this can still outperform in a sideways moving market in particular, but also in up moving markets. So yeah, so I mean that shows just sort of the high level view of how this algorithm did, and just gives people an idea. But it was a very bullish month in April. You know, you can just see from this chart that the S&P really steadily went higher, especially the first couple of weeks. And it wasn't until the last couple of weeks that it started going more sideways. But the fact that we were able to lock in the gains is really good. And it's the reason why I did give this algorithm an A. I probably could have given it an A+, but the only reason why I didn't is the S&P was very strong. And so it's a case where the S&P was incredibly strong, but we still managed to outperform it. A couple other things. So again, if you look at this chart here, you'll kind of see how there were a few days where this algorithm took losses, and one loss in particular was this spike down right here. But remember, this is mark to market, so we were still in that trade. And what you have to remember is that we had a massive spike up here. That was all that the one day that we had where it was up a huge amount. But then some news came out about capital gains. The market sold off, and then we gave back a lot of those gains. But again, this is the day-to-day mark to market kind of profit loss. So we were still in the trade, but this just shows the open trade equity in essence. If you go over here, this is the one that shows the cumulative now. And so you can kind of see, again, S&P steadily goes higher, and then it kind of flatlines a bit. But notice how this algorithm, we sort of kept giving or getting some gains on it. Now it did kind of start selling off a bit the last couple weeks, but we didn't give back that much of our gain zone, so it still was really good for us. But of course, it's never easy to see a spike where we're up even more and then it gives that back. But that's just part of trading. It's unfortunate. There's really no way to get rid of that part of it. But so I've talked about this for a while now. But again, the Momentum ES, that's the second algorithm that's traded in the Phoenix. Again, the Phoenix trades 3. This is the second one. It did really well. It gave us some really strong returns on the S&P, and it outperformed the S&P by quite a bit. The only one that I don't have showed here is the Phoenix day trade. And I don't have it showed here because it really only had 2 trades, and so the chart would just kind of look weird anyway. But it had one winner and one loser. Combined, they were positive by about $200 when you add them together. So I think the winner was up about almost $1,100, and the loser was down about $900. So net, it was up $200. So I gave it a B. Yeah, and this is, a lot of this is sort of subjective. It's just sort of how, my gut feel was about it. But the reason why I didn't give it an A is when we have an up 5% month on the S&P, I probably would have liked to have seen a couple more kind of really solid day trades as opposed to only one winner and one loser. But with that said, what I want to remind you is that this day trade algorithm, even though it's a long day trade, it actually does really good in down moving markets as well as up moving. And that's because of the short covering rallies. And so I did give it a B though, and that's just to sort of close it out. But so again, to summarize these two, the momentum 10-year is traded in all the algorithms we offer, including the legacy. It did amazing. It finally had a trade, and the trade was up a decent amount, even though the S&P was also up. The momentum ES is the main algorithm that we trade in all of our legacy products, along with the Phoenix, and it did really well. I gave it an A. It had 15 winners and only one loser, I believe. The Phoenix day trade had 2 trades. One was a winner, one was a loser, so it got a B. If you trade the swing trader, again, it's basically the momentum, the 10-year plus this momentum ES. If you trade the crusher, it's all of these minus the day trade. It does a different day trade. It's not the Phoenix day trade. It's the other one. And I will talk about those results later. But then the Pro and the Wave are the only ones that I didn't really discuss. Those trade a similar group of algorithms, but it adds to them the Geronimo ES algo, which is one that's similar to this momentum ES, only it doesn't take as many trades. But so that's each algorithm individually. Let's look at the whole package now. Okay, now if you watched the previous end of month video I did, the one for March, you might remember a slide that looked a lot like this one, where I was talking about how we had 2 back-to-back losing months. And what I did is I looked back at all the different periods that we had 2 losing months in a row, just to get a feel for how many of those we had. And we had 17. Now that's in the back test. The following month was a winner, though, 13 times, so 76% of the time. And then the following month was a loser only 4 times, or about 24% of the time. So at least in this very limited data set, it turns out that if we had 2 back-to-back losing months, the odds of the next month being up were actually better than what the overall average is, which I believe is about 65%. And then the following month, the average gain or loss, so averaging the winners and losers, was about 4.4%. So I did that because I wanted to talk a little bit about just how, because you have 2 losing months doesn't necessarily mean an algorithm's broken. In fact, we had 17 occurrences. And so I just wanted to highlight that's all normal as far as having 2 losing months in a row. And then talk briefly about what that might mean for the future, keeping all the disclaimers in mind. So that was last month. And so then this month, you can see that it's filled in now. We actually did about 14.96% on the Phoenix algorithm. And so it's true that I in a lot of ways just cherry picked it, but this is something, though, that I talked about a month ago before I knew we would close up 14%, to kind of remind people that having 2 losing months is actually something that does occur. And when it occurs, the odds are a little bit better that the next month is up. So I wanted to just sort of, I guess in some ways I'm highlighting the positive, and and that I was able to sort of kind of preempt that a little bit. Now it's true that it doesn't mean that we'll always get it right like that, but in this case the odds kind of followed, or the final results leaned in favor of what the odds had kind of showed. So so the final grade for the Phoenix algorithm, I gave it an A. Basically A+ on the momentum TY, A on the momentum ES, and then a B on the day trade. And so you average that out, it's pretty much an A. The reason why I gave it an A is, again, S&P closed up 5%. We outperformed it by quite a bit, 14%. And two of the algorithms outperformed, and then the Phoenix day trade was sort of just okay. So that kind of covers the Phoenix, though. But I do want to also, as I mentioned at the beginning, talk about the legacy algorithms as well, because I know we still have a number of customers that are trading the legacy algorithms. All right, so this just shows a high-level view of how I rated the legacy algorithms for April. So the swing trader, again, is very similar to the Phoenix. The only difference is it doesn't have the day trade. So it was up 13.7%, and so I gave it an A. And you might have remembered when I said that the Phoenix day trade was up about $200, which is about 1%. So that's, you can kind of see how those line up. 14.96% on the Phoenix, and then the swing was up 13.7. So it was basically up the same minus the gain that the day trade had. The wave trader is a little bit of a different beast. It trades the Geronimo ES plus the momentum 10-year. And the Geronimo ES also did really good. It didn't outperform quite as well as the swing did, and that's normal. The Geronimo takes fewer trades, and so on really bullish markets like we had in April, it's normal for it to be up but not up as much as the swing. So none of this should be a surprise to anyone. And then the Crusher actually was up about 11%. Now, what makes that really interesting is that this 11% was based off of a 30K account size. And so so on a 30K versus 20K, if you do the dollar amounts, the Crusher trades the same algorithms, only instead of the Phoenix day trade, it trades a different day trade. That different day trade has a tighter stop. And so so it had the same winning trade, I think it was the $1,100 gain, but the losing trade was only a stop out of about $350 versus about $800. So that's the Crusher. And then the Pro Trader did really amazing. And the reason why it did so well is because it takes the Geronimo ES, that S&P algorithm, the wave trades, the Momentum ES, the one we've been talking about, trades both of those, plus the 10-year, plus the same day trade the Crusher does. And so it just happens that it did the best with the 16%. But again, if you've followed along with the algorithms for a while, you know that doesn't mean a lot. A lot of people will try to chase the gains, and I never recommend people do that. What I mean by that is they might see the Pro Trader was up a lot, and so they might call me or email and say, hey, can I be on the Pro Trader? It was up a lot more than the Phoenix. But what I like to tell them is that, you know, it's never good to chase the algorithms. In other words, you pick an algorithm that you think fits with what you're looking for, and then you just trade that one, because, you know, it's true that one algorithm might outperform the other, but you only wanted to move if there's some really strong reason, and the data really suggests that's the right thing to do. Now remember, the Pro Trader requires 30K to trade one unit in it as well, so it does require more. But yeah, I mean, I did want to at least talk about the legacy algorithms, since I know we still have customers trading them. But overall, I think that summarizes what I wanted to talk to everybody about on this end of April review that I just did. So if you have any questions, feel free to email at sales@AlgorithmicTrading.net. You can always email me as well at Richard@AlgorithmicTrading.net. I think overall, my expectation is that the algorithms will continue to pull out of the drawdown that they're in. I'm really encouraged by the results of April. The fact that the algos not only were up, but for the most part outperformed. In other words, we had a really strong April. That's spells good news for us, I would say. But always remember that there's definitely risk involved with trading futures. It's not for everyone. There's substantial risk of loss. Should only be used with risk capital. And of course, past performance is not indicative of future performance. So with that, I think I'll sign off. But thanks for watching, and look forward to continuing with the weekly reviews that I've been doing. And as soon as we close out the first week of May, which actually will be tomorrow. So yeah, I did this video a few days late. We're already into May by a couple days. But yeah, I'll be doing that as soon as we close out the week. And so I look forward to doing that. And then yeah, thank you so much for your business. And if you have any questions, don't hesitate to reach out. All right, have a great day. Bye-bye.